So tomorrow we get the PCE data. That's really the big thing that we need to be paying attention to and listening to the responses of the Fed from. However, it's been quite an interesting last 24 hours. So let's break it down and let's make sure we're on the right track for the market going forward. We, roughly 24 hours ago, got NVIDIA earnings. This is a very high adrenaline stock. Lots of big portfolios have this stock. Lots of Wall Street loves this stock, loves the semiconductor space, particularly a company like NVIDIA that is very much a winner in it. So they posted a slight revenue beat and earnings beat, and that led to a tremendously strong stock response that carried over into today. And it seemed to trickle out through the rest of the market, into the Qs, etc. Then we opened the day up quite strong. And then after about 30 minutes or so, things settled out and we went into the red. It was like, what caused that to happen? Well, what caused that to happen is probably the fundamentals of reality, because let's break everything down top level and get back into this. But we'll get to that in a second. Actually, first I want to talk about what caused the reversal from that crash. If you look at yields, broke through, 10-year broke through 3.9%, and that caused a market that was excited about yields falling, as we've heard about in the past. So, should yields be falling? Should this be the fundamental case that the market takes? Well, there's a million different conflicting things. We're hearing Jamie Dimon and other banks and even the Fed say no likelihood of recession. So if there's no likelihood of a recession, or we're not in a recession or anything like that right now, why do yields need to come back as if we're in a recession? Why would the Fed need to cut rates if we're not in a recession, right? There's a lot of weird things going on. So as far as I'm concerned, there's no reason for yields to go down. And there's lots of reasons for yields to go up. So yields should just keep going up. And these moves where we're concerned about yields coming down and the response on the market, I just think they're shorting opportunities. I think it's as simple as that. Now, you don't want to necessarily short after a pullback of several days. I mean, let's reality check here. We are down like 4-something days in a row. To have a green day is nothing unusual or nothing to glean too much into, in my opinion. So there we go. I don't really see a whole lot of anything. The yield has been going up like a straight line. We get lower GDP revision, so maybe they can come back a little bit, because we're slightly closer to a recession. Okay, fine, that makes some sense to me. It can happen. No big deal. Again, tomorrow is the PCE. However, we deal most of all in this channel and in this sphere with stocks. And everyone seems to want to go back to the low rate, high growth playbook. And that's just not the case. We have to not compare to previous prices, not even compare to previous price to earnings, because not only were yields low, PEs were historically high. That was like a whole period you need to throw out. You honestly really should be looking at 2019 if you want to look at a comparison. But 2019 was a very different environment because we had lower interest rates and lower inflation. So a lot of things to consider here. Anyways, that paradigm has shifted, but in terms of fundamentals, but the stock valuations have not. So it's a quite an interesting makeup. It's really just quite an interesting makeup that's going on here. Stocks are too expensive. They just are too expensive. You can make that judgment for yourself. Are you buying the stock because you think the stock market's going to go up and you think the company is a cool company and you like the idea of owning the stock? Or are you buying the stock because you actually think you're getting a good return on cash flow and assets for the money you're putting down? In a lot of instances, that cash flow isn't very good for what you're paying for it. And there are opportunities in the market. So when you compare it to those kinds of opportunities as an investor, in terms of what you get delivered as an investor, there are other places that are good to put your money versus tech. Let's take Microsoft, Apple, Google, and Amazon, for example. These are very important companies. These are the four largest companies in the market. And they all missed earnings expectations with the exception of Amazon, which they all missed earnings expectations, actually, I believe. Yes, they all missed earnings expectations. And these were already lowered expectations. These companies had previously been beating expectations, have been growing. That's not the case anymore at all. At best, they are flat in revenue. So, I think it's not such a good time to buy these kinds of stocks. I think it's a good time to short them because I expect this to be the beginning of a trend. Let's not forget what the Fed can, and not only that, this is last quarter. We're now more than halfway through this quarter, okay? So it's going to continue. Not only that, but the Fed continues to say the full effects of the tightening are yet to be felt. So that's today's video. We'll see how PCE comes in tomorrow. It's a green day after a string of red days. It's nothing to look too much into. My opinion, the market's been so crazy the past couple weeks. There's no reason to be watching it every second, okay? Watch these videos, study the news, study the fundamentals, but you don't need to be watching the charts all the time. You don't. I don't do it. I'm not doing it right now. Sometimes I do it. I'm trying to do it less. I'm consciously trying to just relax, chill out, stay focused on the fundamentals now more than usual because that's just the way you should be doing this, in my opinion. You do you, but that's my opinion. So that's today's video, and until next time, peace out.